Hello, everyone. We're live. Welcome to Let's Talk Markets on this August 6th. We're back. We were on hiatus for a few weeks, taking a break, retooling. We've got a lot of great episodes scheduled coming up over the next few weeks, but we're really excited to kick off this sort of next run of Let's Talk Markets Live with Didier Sornette. Didier, thank you so much for joining us.
It's my pleasure.
Didier, you are the Professor Emeritus at the Swiss Federal Institute of Technology in Zurich, the Chair, Professor, and Dean of the Institute of Risk Analysis, Prediction, and Management, Southern University of Science and Technology, and a leading researcher in the fields of complex systems and risk management. Obviously, that all of that plays a role in financial markets. I'm very excited to talk to someone who also thinks about financial markets in nonlinear terms, which has been an interest of mine for many years. I think we'll really get into the meat of this when we start talking about predicting bubbles and crashes. But just to get started, we thought it'd be really interesting to start with the obvious, earthquakes. You've spent more than 25 years advancing our collective ability to forecast earthquakes and other seismic events. And your contributions in the field are widely cited and highly regarded. So we thought we'd start with an easy question. Just tell us when and where the next earthquake is going to happen.
Everywhere.
Okay, done. There you go.
Because if you don't specify the magnitude, there are micro earthquake, magnitude -3, for example, which corresponds to a rupture of 1 centimeter, and they occur all over the place under your feet right now as we're speaking.
There you go.
Very easy.
Very easy. I didn't know it's so easy. Yeah, actually, there was one of these in New Jersey the other day. One of the guys on the team was talking about that. So,
by the way, it shows, if you allow me, Dave, to point that actually when you speak of prediction, very important to be taken seriously and actually to advance the field, to specify, the time window, the spatial region, the magnitude range, and the same thing for, finance and so on. You have to specify the target, and many predictors, so-called predictors, are sufficiently fuzzy that they can always get out of the trap of failures because it's fuzzy, and you always have a way to find that your prediction was correct. It was not actually correctly defined. So I had you, I think, right?
You got it. Yeah, you got me on that one. No, okay, but I do think this is super interesting, just as a sort of segue into finance. But how good has earthquake prediction become? And when is the big one going to happen that's going to destroy California? How about that?
Yeah, so I should say that actually earthquake prediction is the most difficult endeavor ever, right, in my life, and I think of the whole community. For the last 20 years, I've given many interviews, and I always stress that predicting or forecasting, let's say, financial crashes, bubbles, is much easier than predicting earthquakes. Because the earthquake occur at 10, 15, 20 kilometer depths. We cannot see there. It's very indirect, extremely complex, nonlinear. There are a lot of water, fluids, extremely complex multifractal network of faults and so on. It's extremely complex, nonlinear material behavior and so on. So the field has been studying, and there's been claimed that earthquakes are inherently unpredictable and so on. So, but now I think we have, in particular in the US, actually very interesting, there's a history where even the president of the National Academy of Science of the US in the late 1970s requested, maybe you are not aware of that, requested 50 million of the time, $50 million to Congress, because they thought, the whole committee was thinking that we had cracked the earthquake prediction problem. And this was coming from actually experiment coming from the Soviet Union, replicated by American scientists and so on, with great hopes, and then it failed. And then you had a winter period of 10 to 20 years, and then we're back where there's a more positive approach. We are very far from predicting earthquakes. However, we know where they occur in general, because they occur at plate boundaries.
Sure.
There are some cases in the US, in the central region of the US, there are historically in the 19th century 2 big magnitude earthquakes far from plate boundaries, But in general, we know where they occur. They occur close to the San Andreas Fault in California. We expect two big ones in the next century, one above Los Angeles, the other one destroying San Francisco. You remember 1906 was the great San Francisco earthquake, which was very destroying, not only because of the collapse of the building, but it led to the big fire that, because of gas leakage and all this stuff. So we know essentially where the large earthquakes are going to occur in general. The problem is when, of course.
Okay, so obviously we could talk about this for a while, but how did that lead you? That kind of work lead you into financial markets research?
Well, to be fair, because I've been at UCLA for 10 years, there is a kind of bias or misconception that I want to correct. First, I was not a geophysicist. I have been always a quantum physicist, trained in physics and hard science by 3 Nobel Prize in France. And then I started to be interested in rupture. And actually, my first work before the earthquake was rocket science, literally, where we were working on the prediction of pressure tanks about the size of this room, embarked on the European Ariane rocket, which are pressurized at 300 bars, so 300 atmospheres. And we invented this method that then we, of course, developed much further, first for earthquake and then for financial markets. So if you want to really have the genealogy of the process, you have to go to rocket science first, where this process were really successful. It became industrialized, the standard process to qualify the flight of this pressure tank that allows to move the rocket and the satellite in altitude by releasing, by reaction, jets of argon, this rare gas. And then I had the idea of implementing to earthquake, and we started to, but it has never, it has succeeded partially. It's not enough. And there I can tell you much more about what is needed. I think the most successful application has been recently landslide, rock burst, mountain collapse, glacier collapse, and volcanic eruption. So we have now, in the last 3 years, a very long series of papers analyzing more than 100 cases where this technique works extremely well, in addition to financial market. So actually, my approach has been very multi-dimensional or multi-portfolio, if you like, of many disciplines. The earthquake may be the most visible, the most attractive, but it's by far the hardest, because the problem is, where do you define the space to delineate the information that you digest in order to process the engine of prediction? In a let's say landslide, it's easy. You have just one mountain, right? It's very, in the financial markets, it's relatively easy. You have one index, one stock. They are coupled to each other, but you don't have the horrible spatial dimension, the depths and all the space and all the coupling and all this complication.
So from rocket science to geophysical prediction to financial markets, a natural evolution for
and back and forth,
of course, because it's non-linear. You're always in loops, right?
It's very exciting, because I have several cases which were probably for me the most pleasurable instances, where some concept developed in one field could be extended and then in another field, and then feedback illuminating even further the first field is really true interdisciplinary. So for me, it's very exciting to see these bridges helping catalyze new ideas.
As an aside, I actually recently read the Michael Crichton book, Eruption. I don't know if you've ever read any Crichton or if you read that. That was about forecasting volcanic eruptions. And I had no idea how difficult of a problem it was until then.
But it's much easier, I mean, the proportion compared with prediction of earthquake, because you have a relatively well-defined entity. Of course, you don't see very well the magma, but and actually we are much closer to have reliable and it's working somewhat reliable volcanic eruption predictions compared to earthquake, where I would say it's a decade-long work in the future, while the timescale for volcanic eruptions in years.
Okay, so let's talk about, in 2017 you published this book, Why Stock Markets Crash.
If I may,
yes.
It was published in 2003. The 2017 was a re-edition.
Oh, okay.
An extended preface where I summarize the all the the major prediction made from the publication of the book until the reedition, and essentially the point was, wow, everything that I wrote in 2003 worked very well, and is going to continue to work, and probably I'm going to explain to you why.
Okay. Yeah. So let's talk about that. Why do stock markets crash? What is this the process of the building of the bubble? And I've watched your TED talk, and this idea that there's sort of this endogenous perturbation of the system. How do you look at these systems, and how do you characterize them and measure this?
So let me take the bird's view. One we teach in MBAs, in business school, finance, everybody, and this was also the core belief of Alan Greenspan, who actually gave a testimony in Congress saying, I've been functioning according to this belief. I'm going to explain it. And I realized for 40 years, he said, and he said to Congress, I realized I've been wrong, right? I've actually managed the Federal Reserve and the country based on this belief. What is this belief?
Yes, I remember that. Yeah.
What is this belief that is taught everywhere? And I'm spending my time explaining to the students that everything that is written in textbooks is wrong. So what is this belief? The belief of mean reversal, linear mean reversal, linear self-correcting behavior, right? So essentially the idea that arbitrage, you have a price which is too high, let's say according to some measure of fundamental value, of course, arbitrager will come and say, okay, it's too high, so it's going to go back, so it's good to sell. I'm going to make money by arbitrage, and so on. The problem is that it's not the way financial market function. And I spent my life identifying the key ingredients, which I call, and I'm not the only one, positive feedback processes. So mean reversal means negative feedback. You have too many rabbits in the valley, not enough grass, the population will shrink and we go back to the carrying capacity of the valley. That's negative feedback. That's stabilizing, right? And Greenspan was thinking that markets were functioning according to mean reversal, self-correcting processes, and letting free the market, it will be stable. It's not the way the market functions. Markets are strongly functioning and I'll give you some examples later on, according to this pro-cyclicality that has been so famous after the 2008 great financial crisis. Let me just give, so the core of the realization is to realize that the financial market, all instruments are fundamentally, both technically, financial engineering-wise, and psychologically functioning according to positive feedback. The market goes up, momentum is attracting more investors, pushing the price up, etc., attracting more people, positive feedback. The larger the price, the larger the demand, which is nonsense in standard Econ 101, right?
Right.
The larger the price, the larger the supply, but it should not be the larger the demand. So let me give you an example which is not often realized. For example, if I am a bank, I sell you, or an institution, I sell you call option, right? A promise given to you to deliver a stock, whatever, right? At a given expiration, I suppose that our listeners can understand, right? What is a call option? Or
yes, sure.
So now, if I sell you this call option, usually the bank partially hedge the risk. So the point is that this, and it's called the replicating portfolio according to Black-Scholes formula that led to the Nobel Prize given 1997 to Merton and Scholes. So the portfolio that replicates the payoff of the call option is such that, listen to me carefully, the higher the price, the larger I have to buy of the stock. The larger the price, the larger the demand. So even the basic textbook Nobel Prize winning formula that is used everywhere, all the time, and which we are speaking of a quadrillion, 1,000 trillion US dollar of nominal value underlying all the derivatives, is based on this idea that we neglect the market impact. But actually, as soon as you take the market impact, there's positive feedback. You have portfolio insurance, you have so many technical analysis and so on that give this positive feedback. The biggest mechanism, in addition to all this, is of course psychology. We are herding animals, herding mammals, and we are actually dominating the planet because our brain is so strong that we know how to cooperate. single, you and me, we are weaklings, right? But together we kill the mammoths, right? We dominate the planet and so on.
Mm-hmm.
And this trait is very well known, much studied in psychology. We learn by imitation. Babies imitate the parents and so on. And right now, for example, our discussion is going to be listened, hopefully, by some person who are interested, and they are going to learn from it. It's kind of imitation, of course. When I'm teaching, it's an imitation. We learn by imitation. And it's rational to imitate because you may know, Dave, something I don't know. If I see you buying excitingly, very strongly some stock, and say, Dave knows something I don't know. Maybe I have to watch, and maybe I will imitate, because, etc. So this all gives to the conclusion that Minsky is right. Financial markets are fundamentally unstable, driven by positive feedback, procyclicality, that give rise to long periods of growth above the fundamental that can last years, sometimes decades. And then there is the famous mean reversal. But the mean reversal is not, the smooth thing that you would expect according to the textbook. It's like an enormous, acceleration, and then boom, a rupture. So this is essentially my understanding of financial market that I want to share with you and your listeners. That indeed there is a long-term mean reversal, but it's extremely non-linear. So the picture is like very stochastic, positive feedback and rupture. And all this, going on forever in various ways with various stories and so on. And so the key to now summarize, to answer your question, financial bubbles can be diagnosed and crashes to some degree can be predicted once you understand this mechanism, and then you are going to look for the signatures in the financial price, in the volatility, volume of transaction, open interest, and so on, about the presence of these positive feedbacks.
Okay, and so it's funny. I mean, we had this saying when I was a trader. It's like an escalator on the way up and an elevator on the way down, right? Which is essentially what you're describing. And I think what's sort of where I come at this is having read Chaos Kings, which I found to be a fantastic book, and I know Scott Patterson, and I think very highly of him. I think Taleb would not disagree with anything that you have said so far, right? He would be on board with all of that up until this point that you get to where you say, but not only is there this reinforcing feedback loop, which then results in the bubble bursting, but there's also this element of predictability to it. It's not just that you're describing the phenomenon, but you're also saying that there is a way to predict that phase transition. Is that right? And if so, what is the fundamental disagreement there in terms of the black swan versus, maybe you want to introduce your idea of the Dragon King?
Yes, thank you for this question. Yeah, so I've debated quite often with Nassim Taleb, maybe not enough, I would say, but we have a few recorded debates together, right? Exchanging even our books and so on. I remember in New York in 2013, quite a lot of fun. So he's my friend on one hand, right? He when he wrote Fooled by Randomness, he was calling me very often to share ideas and to check ideas with me and the technical aspect. So we have been exchanging a lot. So he's my friend. On the other hand, he's my intellectual enemy. Enemy because I consider black swan, the concept of black swan, the black swan is considered as wrong and dangerous. Wrong and dangerous. So let me elaborate on this.
It's a bad combo.
Yeah. So in principle, theoretically, black swan can exist. They are just popularized version of what is known as unknown. I'm not going to cite Rupfeld, right? But I'm going to cite Professor Knight from the University of Chicago in 1930, who introduced this concept of unknown, right? The black swan is essentially the popularized version of unknown. For example, the September 11 is often cited as an example of black swan, something that is inconceivable in the mindset of America. Even if the CIA knew about it, etc. But for the public, it's a black swan. Of course, for the knowledgeable intelligence, it's not a black swan, because there are many scenarios about this. But essentially, a black swan is something that you cannot even imagine that exists. You see all white swan everywhere, a black swan in New Zealand. Oh, okay, it changed my view of the world. Just this event. Why do I say it's wrong? So it's an interesting and correct intellectual construction, but I don't know any single real life example where an event is a black swan. Because essentially my claim, we are speaking of earthquakes, landslide, volcanic eruption, material failure, rocket breakdown, bridge collapse, etc., earth and finance. I don't know any large event that is not preceded by precursors. So the key idea is that this is essentially my life, the philosophy of my life, right? My personal built wisdom. So the process is always that system mature towards an instability progressively. So it's also true, by the way, I'm working a lot with physicians also for cancer, for health problems. They don't fall on your head, right? It's like not a stone crashing you. It is a process, inflammation, chronic disease, then cancer. So and you have to listen to all these telling signs. So this is where I am saying is wrong, and it's dangerous because you can wash your hands. When you have a policymaker and you say 2008 is the black swan, Nassim Taleb, by the way, said it's not a black swan. He also saw it coming and so on. But when policymakers hide behind the black swan, it's not by fault, right? It's not by policy. It's coming from the sky, and then you remove your responsibility. That's why I consider the black swan concept as dangerous, because it allows you to escape any responsibility. So so to answer or to combat, let's say, to fight against this bad conception, I introduced the concept of dragon king. So the name embodies a double metaphor. King is related to the king effect. You know, it used to be that the king, you have the Pareto distribution, the fat tail distribution of wealth, let's say in a country, that Pareto discovered, Italian economics in, I think, 1896. And you have a king. The king is like a singular family who has controlled the country, sucked up the riches over centuries, and is like a singular wealth in the otherwise continuous distribution. So the king effect. And the dragon essentially emphasized that the mechanism behind this king effect is special. So the dragon effect, the extreme events that you are interested to predict, for example, the large crashes, result from this positive feedback that are building up enormous bubbles, which are not sustainable. They proceed towards what we call a finite time singularity, means that it's finite, the lifetime is finite, and then the crash is of such extended amplitude because of this piling up of procyclicality. So that's so we indeed diverge a lot on this with Nassim, and indeed he has he's advising Universa, this hedge fund, and they have developed what they call the Black Swan Protection Protocol, which is essentially buying option, right? So you always speak about convexity and so on. So you have a sucker in front of you, right? You have to have AIG, for example, right? Which sells you CDS, credit default swap, and then you make a lot of money like this incrementally because you collect the premium.
Yeah.
But then when big crises occur, of course, you have to deliver the insurance, and then you collapse, right?
Yeah.
So the strategy of Nassim Taleb, I don't want to say too bad things about it, but essentially you have to have a sucker in front of you that actually sells you the puts. And this is not a strategy that can be adopted by all, okay? Because obviously you need to have a majority who is wrong, and this strategy is exploited by a few who buy the puts. I have developed as a countermeasure what I call the Dragon King Protection Protocol. And the idea is very simple. We do exactly like the same. We buy puts, but we buy puts conditional on the signal that the bubble is ripe. So it means that full invested in SP 500, for example, and then we have, but it's not very, we don't claim to have very precise, over 3 or 6 months. We ramp up the put, and then the result is that no adjustable parameter, nothing. We have performance which is like over a period of 10 years, like 4 or 5 times the return per year with much smaller drawdowns. So the point of the performance of the Black Swan Protection Protocol is that it looks great when there's a crash. Of course, they make 100%, but they are increasing all the time.
Right.
So the point is that, and so you have to, okay, so you use this strategy as a protection on the side. A few fraction of your portfolio is there. If you understand the procyclicality that I've been explaining, you can do much, much better, and therefore time a little bit the when you really need the protection.
Okay, so you've been doing this, I guess. Is this a fund that you've been managing, or this is just something you do on the side, and has that led to the Financial Crisis Observatory?
So yeah, so with my previous students, we have launched a hedge fund actually in China. It's called Gaia, or the goddess of the earth. It's performing very, very well in the last year. We are number one actually as a hedge fund in China. So we're growing well, and we're using this type of methodology. And in complementary, when I was at ETH Zurich, in reaction to the 2008 financial crisis, I was really, between you and me, I was disgusted by this hiding behind the black swan story, and so on. So I decided to launch this financial crisis observatory, funded 100% by my academic resources, to propose to provide a monthly report analyzing thousands of assets worldwide to provide diagnostic of where are the hot assets, what are the dangers, so on and so forth, in order to educate progressively that indeed we can do, and there's very important concept that is very close to my heart, dynamical risk management. You know, and let me explain what it is. So the standard risk management in all banks, all institutions is what I could call more passive or more static. So for example, you protect by value at risk, expected shortfall, and you build measures. So I make often this analogy. I am an avid motorcycle driver. I have 5 motorcycles of extreme capacity. So, and I always make this comparison. You know, passive risk management, which is done in banks and institutions, is like carrying a helmet, the glove, the protection, and so on. Right. If you know what is a motorcycle and you drive it very extreme, you want never, ever the passive risk control to be in action because you are dead anyway, right? What I do is dynamic risk management, which is watch, predict the B. So the key word is predicting not only the surface of the road, the pebbles, the oil that could make me slip and so on, but also the behavior of the other drivers, which are the biggest danger. I don't want, even when there's a red line or a green line for me, I want to predict that maybe a car will not respect the red light. I don't want to be right in the wheelchair. So this is what we are trying to do, to implement in finance, to this dynamic risk management, to do this Dragon King protection protocol, to not only reduce the risk tremendously dynamically, but also to increase the return.
Okay, and so this year, I mean, you launched it, the Financial Crisis Observatory. As you said, the idea came around the financial crisis, but it really launched last year. But it seems like this year, and I've been following it sort of throughout the course from last year, it's really come into its own this year, and you've rolled out a lot of new reports and features. What's that been like, and how has the reception been?
Yeah, so thank you for allowing to make clarification. Actually, we launched the Financial Crisis Observatory as academic endeavor in 2008. Okay. And then actually the version that you are mentioning is the professional, because I don't have anymore the great resources of the Swiss Federal Institute of Technology. I had $2 million of funding every year. The only problem was to spend it, right? So great opportunity to...
Great problem to have, yeah.
in research, which I've taken, I've been working on many things. So now I would like to, and I am continuing to do the research, but self-funded, of course, with a hedge fund, but here self-funded by having this professional version that we provide through different subscriptions. And we provide to, retail investors, every small investors, they can, all the way to professional hedge funds and pension funds and big institutions. So yes, I mean, we have just started about 7-8 months ago, something like this. So we are growing, there's a progressive adoption. I hope maybe this discussion will attract more attention to it.
Sure.
So I think we deliver useful information. Every month we provide again a monthly report with like 50 slides looking at all the market in the world and making specific, taking a risk, making prediction, outlining where are the hotspots, and also providing a global macroeconomic geopolitical analysis, also to complement the more technical analysis of these positive feedback signatures. And we also, in addition to the monthly report, provide daily update of all the signals on about 1,200 assets of all types, right? From indices, stocks, bonds, commodities, crypto, etc., foreign exchange, and so on. And so it means that we have a number of users who actually use this in order to time, to see, when there's a risk of a correction and so on, and you can therefore develop different type of strategy. And we also provide, not so regularly, maybe once every 2 weeks, some trade ideas based on our own analysis to suggest what could be interesting signals. So this is an offer that we are going to scale up progressively because it takes time to make it automatic.
For sure.
And we want also, and this is on the pipeline, to develop more systematically the Dragon King protection protocol to demonstrate on a number of indices and so on how people actually can just follow it.
So can you tell us when will this U.S. market burst? I mean, I assume you're paying attention, you're watching it. It just goes inexorably up. It doesn't seem to matter geopolitically what's happening, politically in the U.S. what's happening. It's nothing but up. When you look at that, I mean, that must fit so well into your sort of conception of these, correlated returns that deviate from the mean reversion model. Like, what are you, when you're looking at the U.S. market specifically, what are you seeing right now? And obviously, like, asking you to predict when it's going to crash is silly, but what do you see and how do you look at it? Let's talk maybe
so
for that perspective.
I see a lot of exuberance. I see a lot of also imbalances. When you say it's only going up, of course, as you know, there was a very significant drawdown following April 2nd.
Yeah, Liberation Day, we covered it, but we thought that was maybe a shift, a regime change, maybe something was happening.
Exactly.
And yet, after that,
So what is very important also, Dave, to realize is how short a memory we may have, because we can, and this is actually a very strong, doing good investment is about understanding your own psychology and your bias and the one of the market. And one very important mistake that all of us tend to make is to reinterpret the past given the present knowledge, right? So this is the hardest thing to do.
Absolutely.
So, for example, I can give you very quick, before I'm not delaying my answer to the hard question you're asking, but I just want to point out one case that really shocked me tremendously. I was invited to be an external, let's say, participant to the Federal Reserve European Central Bank conference in Frankfurt. I think it was around 2011, to analyze, like post-mortem what went wrong, with the crisis and the European crisis that followed in 2010 and continued over several years. I remember, I will not name the guy, it's one of the famous economists, top economists of the Federal Reserve. And he said the following, so he said, I should say, that from 1980 to 85 to 2008, this was a period called the Great Moderation. I don't know if you remember. And it's essentially 25 years of exceptional performance where growth of the market, with low volatility, so no risk, price with intermittency, of course. GDP very strong with low volatility. What else? Unemployment low and decreasing and low volatility. And so all the measures were impossible. I mean, it was considered great moderation. And Greenspan and many pundits everywhere said, we have mastered the beast. Now we know we have diversification, we have distribution, the CDOs, everything. We know how to manage the planet, right? And so this economist, coming back to Frankfurt, 2011, he said, the GDP was strong with low volatility. The financial market was growing with no risk price. What else? Unemployment was really small and with no volatility. Clearly, this was abnormal. I mean, look at this statement. Clearly, this was abnormal. So during the run, everybody was congratulating themselves, shaking hands. This is a new epoch. I remember Lucas, Nobel Prize winner and president of the American Finance Association, even said famously in 2005, we need to remove the word recession from textbooks. Because we understand now, we are controlled.
Yeah.
The finance
Talk about hubris.
Yeah, exactly. So, and now in 2011, the big crash occurs, the Great Recession occurs, and people say, oh yeah, it's clear, they were diagnostic. So this is the mother of not learning.
Yeah.
The top guys don't learn. So it's scary for me because we are, and this is one part of the answer to your question, we are driven by not only politicians, that's one thing, but by actually policymakers. I'm speaking of the top of the Fed, or the top economists, etc. They have no clue. They don't learn. And they have actually even a vested interest of not learning. Okay, that's another thing. So this is a question. So now to go back to your question. Yes. So, and why did I start to discuss this? It's because after the Liberation Day, the market crashes, and you said correctly, many people were saying, now it's a transition, clearly, and there was a lot of argument to think that the new regime would, and maybe there has been the past 20 years of sideway or drawdown, and many people were afraid of this.
Yeah.
Okay, and now it seems forgotten, right? Going back to normal, so to speak.
That's right.
I know I'm normal. It doesn't mean that it can come back. And it's very important to remember what was the thinking 3 months ago to actually learn what is going to occur in the future. So for me, I'm quite concerned. So I'm watching the market very interestingly for exploiting short-term corrections. So this is what I can see. Of course, there will be shortcut correction. And of course, it is. So if you look at indices, you can see this coming, and you see also in different sectors, industry sectors, in different stocks, in different assets. As you know, for example, if you look at the S&P 500 ETF, whatever, you see it growing. It's close to its maximum ever, right? Just today,
always hitting all-time highs. Yeah,
close to all-time high. But it is driven by not even 7, 3 or 4, 5 stocks maximum, right? Now you have 2 or 3 companies, I think, that have passed $4 trillion capitalization, right? Nvidia and Microsoft. And so it's like levitating while the rest of the capitalization doesn't participate, essentially. So this is a level of concentration and off. So I think this is the AI bubble going on, right? So early on, since the last 3 years, we can see all the tell sign of the bubble, like .com, right? You have many parallels. I'm not the only one making these parallels. And indeed, so there are several scenarios. Either, the massive investment and the hope for a rebound in productivity growth. The financial market should be rationally let's say, evidence, the signal of what will be the future performance of the economy. So in a way, you could say, if you are optimistic, you say, the high pricing of the market is essentially pricing in the expectation of a new burst of productivity that has not been seen for quite a while due to revolution. This time is different. The most dangerous statement ever in finance.
Always, yep.
This time is different due to the AI revolution. So that could be a scenario. It could be a very great surprise. Another scenario, which is, in my view, much more likely. In my experience, I've studied a lot of technological advances. I've written many papers and so on, and also looking at the impact on finance. I will cite Solov, the famous Nobel Prize winner. He said, I remember in the 1990s, he said, we see PCs everywhere except in the economic statistics. So what does it mean? It means that in order for a new technology to impact productivity growth, it takes 2 decades. And this is, and so people say, but now it's different. Of course, this time
everything's faster. Yeah.
But before it spread and really penetrates and really push all the industrial network to gain so much of productivity, it will take a while. Only certain sectors can benefit. So I think that it's a typical bubble. Now, of course, you have to surf it. Okay, you cannot stay on the side. And then you have to subscribe to my FCO to know what to do.
Okay. But I mean, look, you've been paying attention to technology and markets now for quite a while, for decades. And what I think is ironic about the AI bubble is that this is not the first time. It's
Yeah.
specifically for AI,
Yes.
right? For artificial intelligence. In fact, if indeed this bubble does burst, or when it does burst, I think we'll head into the third AI winter, where every time AI has sort of come into its own, the promise of the technology has far, and the hype has far outpaced its capabilities, which is in fact, I think, a lot of what we're seeing with current large language models. So now I'll deviate a little bit into the tech side of things versus the market side of things. But this is something we talk about on here quite a bit, and something I spend quite a bit of time on. And I do think that we're seeing, exactly today what we have seen in the past. And so, let's say we're fully bought into that, and everyone's going to go now sign up to FCO because we want to know, when do we buy those NVIDIA puts? So how do you make that prediction, and how much of it is going to look like Universa for a period of time, right? Like it's inevitable that you're going to say this is a bubble, it's going to burst. Even looking at the types of things that you're looking at, and you have, let's say, these nonlinear measures and these log power laws that you have fit to returns in the market, and you're seeing the deviation. How do you know when that deviation is finally reached its limit, and we're about to see that massive reversion that is coming? I don't know if this is going to be too technical of a question, but this is really what interests me.
I will try to remain understandable. So first, let me just resonate with the first part of your statement. I remember when I was a master's student, so quite some time ago, like 40 plus years ago, there was the first AI bubble. I remember visiting, so this was when the neural network were thought to solve every problem, like artificial brain. And I remember meeting top executive at some of the major banks in France, like Société Générale, BNP, and so on. Some of the biggest in the world, actually. And they were asking me, okay, do you think that I was a young, relatively growing fame in France, and they were asking me for advice and so on, because I was quite technical and so on. So they asked me, do you think that we can actually replace all our traders by neural network? So it was 1994.
Jeez.
About 30 years ago. Yeah.
Yeah.
I was a bit more than a master student. I was older than that. Okay, so the same story. Now, to come back to your question, yeah. I need to add some element to the big, let's say, the picture, the narrative I have shared with you until now. According to my understanding, studying the market, the economy, and also the behavior of policymakers and the market, and also with respect to all the technical indicators that we are developing, I can really say that there is a change of regime in terms of the structure of the market from 2008 onward.
Okay.
And it's very easy to understand essentially where it comes from. But we see this in the market very clearly in signature that were not present before and are present since then. For example, signature, by the way, technical is this kind of thing. Boom, boom. Like a drop which is rebounded within hours or within a few days. Never happened before. And you see the big hand of the central bank. You see the big hand of let's say intervention. So the thing that has changed fundamentally is that markets now are controlled by central banks. So so if you want to be successful, before 2008, the central bank had a role with the monetary policy, etc. We know all this, right? But as you know, the Maastricht Treaty in Europe and the Lisbon Treaty prevented or forbade the buying of bonds, treasury bonds, by the central bank, by the European Bank. At the peak of the crisis, 110% of all emissions by all countries in Europe were bought by the European Central Bank. Hong Kong, Japan now are buying outright ETF of stocks, right? To control. is called the national team, right? They have a very nice way of representing the government intervention. The national team intervenes. Recently, they intervene actually in the Chinese market. In the in Europe, the national team, if you like, are intervening to be sure. And this is what we've seen now. There is no crash more than 20% anymore.
Right. That's right. Yep.
Interesting. That's super interesting. So 20% is like, okay, because then it's going to rebound fast. That's what we saw with the Liberation Day that we saw before, and we can look at the last 5 years, just no more than 20%. And then it rebounds super fast.
Yeah.
You have the big imprint of the big guys, the national teams coming in. So the point is that it's interesting because you need now another layer of understanding and also reading the markets, of seeing that indeed there is, and we understand why, there's a fundamental interest in preventing big crashes. So my understanding, and I take the risk of stating this as a prediction, there will not be crash of the magnitude that we saw in 2008, or the magnitude we saw in 1987, or the dot-com that we saw in 2000, and so on, because now they know that they can intervene, and they do intervene. The reason is very clear, because the stock market is not only the diagnostic of the future economy. It's like it should be according to theory. It should be according to what you learn in MBA and so on. But it has been, because of the thermometer of the future health, the best way to convince everyone that the economy is right and that my policy is right is to buy the thermometer, obviously, right? So you hit the thermometer somehow to say things are good, they're hot, you're not cold. This is exactly what is happening. So you manipulate the thermometer, and it is really the measure, and not only that, it is also through the wealth effect, right? As the market goes up, everybody gets richer, the collateral that you have to get credit is higher, and so the whole economy is functioning based on a healthy stock market, which is really on amphetamines, right, on drugs, the equivalent athlete, which is pumped up. I always remember on this level the quote of Larry Summers, president of Harvard, Treasury Secretary, famous guy, economist, and so on. In 2012, June, I remember very well, he wrote an op-ed in the New York Times. And he said the following, and it expressed exactly what is going on now. Still, he said, the paradox is the crisis of 2008, 2010, etc. comes from too much finance, too much debts, too much leverage, too much excesses, too much credit. The paradox is that in order to go out of this, we need more debts, more finance, more credit.
Right.
So I have a big hangover. I drank a lot of whiskey. The solution is more vodka.
Right.
It's exactly what is going on now.
Right.
So now, to answer more precisely to your question, you understand now that I don't expect a big crash.
Okay.
So what I do expect, and that's what we are trying actually to provide as information, advice, and so on, by our metrics, the indicators, is the transient corrections that may last, a few weeks to a few months, that would be up to an amplitude of 20% that you can actually exploit. So that's now here I am, of course, biased toward the US. Now, if you are taking an international view, the story is totally different. Internationally, you can have big crashes, especially in emerging market, in let's say Japan or in other places. So so that's already a long answer. Maybe you want to ask me something else.
No, this has been a fascinating conversation. I'm going to also pop up on here. If you want to check out the Financial Crisis Observatory, there is the link, sornette.finance. And Didier, I really appreciate you coming on. It feels like a conversation that could go on for quite a while. Maybe you'd join us again at a point in the future, and we'd love to dive deeper, I think, into the kind of reports you're putting out, and maybe talk about some of the things you're seeing in markets from time to time. But I think you have a great perspective on markets, and one that I really think people need to hear, because it's very different than what they're being told.
Yeah, I could share the screen of future discussion showing you how to play with. It's really a game. It's really very nice interface, and I could walk you through how we read the signals and how we play with these things. So that could be another opportunity.
Yes, I think we should absolutely do that, and hopefully that'll show people a bit more about what you're doing at the Prices Observatory and why it can help them in their own investments and money management. So thanks again for joining us, and thanks everyone for listening in. It's great to be back with Let's Talk Markets. And we hope to see you at Irvin. So make sure you're jumping over to irvin.finance. Give us a like and a subscribe here, and we will be back next week. And what is it? Sorry, I should have looked at this. Next week, we're going to be joined by our buddies at the Investors Exchange, IEX, and we're going to be talking about their new options exchange, IEX Options. So thanks again, and Didier, thanks again for joining us. Really appreciate it.
Really a fun conversation. Thank you, Dave.
Yeah, it's great.